Hi, this is Victor, and welcome to the Active Value Investor channel. On my channel, I analyze investments that I make and then share my analysis as well as my experience in those investments with other YouTubers. I've learned a ton online and use that, firsthand experience that's shared to manage my investments in my portfolio. In this video, I want to talk about bonds and provide a bond report. I started to invest more in bonds in 2022, and as yields went up, the return on bonds became more attractive. And as 2022 really punished stocks, especially high growth technology stocks really took a beating in 2022, bonds became really interesting to me. There were three things that I wanted out of my bond portfolio. I wanted to diversify, away from stocks and real estate with bonds. That's traditionally been a good reason why to look at bonds is diversification. And that was one of my goals. I wanted a positive return, 6 to 8% per year. And that's a nice, consistent, return from part of my overall nest egg. And I want to generate consistent cash flow. As I get older, cash flow becomes more important. Just looking at someday retiring, cash flow is going to be important in my retirement years. So today, February 3rd, 2023, there was an employment report that came out. And the good news is that the economy created more than 500,000 jobs. And the unemployment rate is at a 50-plus year low. So very low unemployment. And that is good news for a lot of people that have jobs, but it's news that the Federal Reserve will have to continue to fight inflation by raising interest rates. That said, this is the effect of that news on yields of the U.S. Treasuries. From short-term yields to long-term yields, there was a pretty significant increase in interest rates. And what that does is it drives down the price of a bond because a bond has a specific interest rate it'll pay. And so as yields go up, the bond price goes down. So it's actually a very good day to buy bonds. So I put in a buy order on two orders. And I'm probably going to look at it further later today. What it also does, increasing interest rates put pressure down on stocks. And it's 6 a.m., so markets haven't opened. But you can see that the NASDAQ's going to open more than 2% down. The S&P will open more than 1% down. So we'll see a down day of stocks, and we'll see better yields in bonds today. Over the last 5 years, here's graphs that show where interest rates have gone, and the change of interest rates. They really dropped in 2019 heading into 2020. That created really low interest rates on homes. It became very attractive to get into very risky stocks, high growth stocks, because the discount rate was very low. So the valuations of those companies were very attractive. That persisted through the pandemic because the Fed had to make it easy for the economy to basically function with low interest rates. But as inflation really hit, they had to really start fighting inflation with raising interest rates. So those interest rates really flew up. An example, interest rates at their low, you could have gotten a home mortgage on a principal residence of probably 2.5%. That's what I got. That's what I have on my home. And at the peak, you were looking at 7% interest rate. So that's just more than a doubling of the interest rate, and really made the affordability of buying a home very difficult, as an example. And we obviously in 2022, as we saw that interest rate go up, stocks were really, the prices were really pushed down because the discount rate on a valuation of stock was very changed with a higher weighted average cost of capital for those companies. So just a really interesting period that we're investing in. And it's interesting to see the chart of how these yields have gone up over the last 2 years. In 2023, year to date, interest rates have been falling. and they had been falling. The stock market had been thriving. So it was great for stocks, but we may be hitting kind of a high because it's now clear that interest rates will have to go up. So it provides an opportunity for me to look at bonds to diversify. I had sold 3 positions in 2023, and they were more of the high growth tech stocks that I sold when I got back to a good price. The prices had been valued higher than my intrinsic value I had on those companies. And I was beginning to doubt myself yesterday and 2 days ago when, boy, yesterday, especially with Meta going up 25%. I still own Meta, but I was beginning to doubt that maybe I shouldn't have sold those positions earlier in the week. But having seen the data today, I'm really glad I did so. I put together this chart to compare the S&P to a couple of investment options out there: the Vanguard short-term bond fund, Vanguard intermediate bond fund, and long-term bond fund. And you can see that, the short-term bond fund is no way keeping up with the S&P, because the S&P is just, doing great. But as we look at the long-term, it's riding up there with the S&P. And that's because as interest rates go down, the value of bonds go up. And the long-term bonds that can guarantee that long interest rate, the value of those bonds had been picking up during the first month of 2023. The only difference is about a 2% difference between the S&P and that long-term Vanguard bond. And again, you get to diversify as we see, according to, the futures market, the S&P is going to drop more than 1% today. You wouldn't see that in a bond fund. You would see just fractions of a percent movement per day. You might see 1% movement in a month. Here are 2 bonds that I own. These are individual corporate bonds. The first one on the left is Ally Financial, and it's about a 4-year term on the bond. After 4 years, they'll return the face value of the bond back to me. And the yield is 6.6%. I track Ally Financial, I analyze it, and I own their stock. So I know it's a good company. And they pay a 6.6% yield, nice dividend payout, and I get my capital back in 4 years. A shorter bond with Energy Transfer has about a 1-year term, and it's paying 5.8%. Again, a really nice rate of return, stability. In a 1-year term bond, the value of that bond isn't going to change very much, because in less than a year, they're going to give me the face value of that bond. This is a very strong company. So there's very little risk in this particular bond with a very good return. So as I look at bonds, it's giving me the diversification that I'm looking for. And I like to do or look into markets when they're not as popular as at their height. For example, 2023 stocks are just flying up, and that's going to come to an end. Right now, buying bonds is pretty boring and not as exciting as stocks. So it's a good time to really look at them, to just diversify and have a more stable part of my overall portfolio invested. It gives me a guaranteed rate of return of 6 to 8%, and that consistent cash flow that I would like. Give you an example. If you're retired and looking at my retirement, and we had a year like 2022, it'd be very hard to sell your stocks, because those companies are worth far more than their stock prices, but the market is just driving down stock prices. Bonds could really step in and provide that cash flow, so a retired person can, draw out their dividends and live off of them. So I like that idea, and I'd like to start building a really nice portfolio of bonds. Thanks for watching my video. I hope you enjoyed it. Maybe discovered something new about bonds. Maybe it spurred an idea. Take a look at bonds to diversify. I think it's a good time, an interesting time to take a look at them. Thanks again for watching. Good luck investing in 2022.